Welcome to the community of people working together with Side Hustle, a community that enrich and inspire other people, a community that changes lives for the better. Welcome to the community of people working together with other people for leverage effects and passive income. We are international, we have no borders. Join us and let's make money together. Together we can, alone you cannot. Walk this journey to success with us. Side Hustle, community of people. Side Hustle, hustle hard. Side Hustle, a community that enrich, inspire, and changes lives. It doesn't leave anyone behind. Welcome to Side Hustle. Change your life, change your pocket. Everything is possible with Side Hustle. Time wasted, never regained. Be part of our community. Join now. Side Hustle. Side Hustle. Change your life.
Indeed. Welcome to Side Hustle. We are here to actually empower and change life. So today we'll be focusing on understanding what is forex. This is actually forex beginners course, and whether you are intermediate, whether you are elementary, whether you are experienced, this course is still for you, right? So today we'll be delving deeper into understanding what forex is about. And a lot of people would say, okay, I want to know, what does forex stand for, right? So forex stands for foreign exchange market. It actually refers to decentralized markets whereby you find that global currencies are bought or sold. So today we're going to emphasize the most important thing about forex, what people do when they buy and sell. Right? What do they really buy or sell? Right? So now the most important thing that let me just, those who are watching me from YouTube, make sure that you can comment below. You subscribe as well for our next courses, so that you don't miss out on the next upcoming masterclass. So let me quickly share my screen with YouTubers so you can see what I'm talking about. There we go. So we'll be exploring more about what forex is about from the beginning till the end, so you can understand what do we mean when we say this is a foreign exchange market, right? So the foreign exchange market, like I say, known as forex or FX and or currency market. A lot of people say it's a currency market, right? So we know that it's a over-the-counter global marketplace. That's where you actually determine the exchange rate of certain currencies around the world, right? So, but we also need to understand who are the participants in this market, right? So we know that we are buying and selling, and there is an exchange, and people can actually speculate, right? The exchange rate of various currency pairs. But who are the main players in this forex market, right? So we do know that this forex exchange market are made up of the banks. The banks are involved in this currency market or exchange market. Even forex dealers, commercial companies, central banks, investment management firms, or property firms as well. Even hedge funds. We see even retail forex dealers, they are more involved in this, and not leaving out the investors as well, right? So here's a key takeaway that you really need to take out of this what is forex beginners course, is that we say it's an over the counter because of that's where people can actually buy and sell over the marketplace, right? And they can determine the exchange rate for other global currencies, right? It is by far, the largest. When I say the largest, it's bigger than the stock market, stock exchange. It's bigger than equity exchange. So it's bigger than all the financial market that you can ever think about. It's the largest financial market in the world, and it is actually comprised of all this global network of finances, and we see the transactions happening 24 hours in a day, right? Meaning that it's only closing on weekends, but you find that some brokers, like where you trade volatilities, boom and crashes, you can still trade on Saturday and Sundays, right? So, but overall, the currency market, the stock market, it's actually open 24 hours in a day, and weekends, people find that they do not actually trade during that time, right? So now we look at the currencies, right? So we see that currencies are actually traded in pairs, right? So they're traded in pairs. Why? Because of the value of one another currency. You find that someone is trading the value of other currency against the other currency, or in just one pair, right? So you can actually see or compare the relative value between the other, right? So now that's the reason why people buy forex and selling currencies or code, because of they do understand, the pair. Of course, we're going to delve deeper into it so that everyone understand what do we mean by that, right? So welcome to our forex beginners course. Make sure if you're from YouTube, you subscribe for our next master classes. So we're going to also understand, the foreign exchange market, right? So understanding it, its origin, it is this original financial market that is actually formed by the or to bring structure, to the global economy. So in terms of trading volume, because we say that it is thus far the biggest financial market in the world. So we're talking about 7 trillion traded every single day in this market, right? That contribute to the economy as well, right? So this forex market actually enables currency so that people can convert, right? They can convert international trade settlements and investments, right? So it will help them with that regard. So we see that currencies are always traded in pairs, like I told you, because of the value of one another currency that is paired to other relative, to see the value of the other, So this actually determines how much of, maybe, let's say maybe we are buying USD ZAR, right? This actually helps us determine how much, USD is currency is compared to ZAR currency. One can buy vice versa, right? So it's actually establishing this relationship of prices, right, for the global markets in the main function of the foreign exchange markets, right? So this is also, something great, because of we see when that performance happen, it creates what we call liquidity, right? So this liquidity in all other financial market, it is the key, to stability. Any business, you still need liquidity in order for you to survive. You still need liquidity in crypto market in order for you to be able to transact, buy and sell, or even, to say that this is valuable, right? Liquidity plays a major role in everything. So here we're talking about the value of country's currency. You find that they depend, whether it is free float or the fixed float, right? So, but enough about that. We want to talk about the basic so that all the, your beginners, can understand the basics instead of complicated stuff that are not necessary, right? So we now know forex market in abbreviation is just exchanging of national currency against one another. So that is the first key point that you need to take, right? And now, secondly, we talked about the market participant, in the forex market who use forex, to hedge against international currencies, right? And maybe sometimes interest rates as well. So, or interest rate risk at that particular. So so that they can speculate, right? They can speculate geopolitical events, or they can what we call diversify their portfolios among several other reasons, you see. So now we talked about the market participant, we talked about the major players in the market who tend, to be financial institutions like, your commercial banks, your central banks, which are involved in this market as well. That's why I'm saying that you find that you're banking with a certain bank, right? And when you're banking with a certain bank, overall they take their clients' money to go trade some, foreign exchange markets, or be involved in foreign exchange market, right? But in returns, they give you only 7% annually, right? So, but you find that they've made even more, using your funds in that instance. So you also need to understand how you can trade forex. Do your own forex market. The good thing about it is that it doesn't actually involve any third party, whereby you need to buy through a third party so that you can be involved. You can just be involved individually and independently, right? So it's an individual market. It's an individual. We call it retail traders because of they are very small relative portion of all the forex volume that involved. So now you find that retail traders are involved. The global corporation, they use forex market to hedge this currency risk, from the foreign transactions. Let's say I'm exchanging my rate, or I'm trying to buy USD ZAR, right? Through that conversion, right? There is actually a lot of money that is made, So, but we're going to dive deeper into that so you can understand step by step everything that we talk about, right? So now we dove deeper into what is forex. We talked about the price paid for one currency in exchange for another, and there are actually 180 different kinds of official currencies in the world. You find that some they're categorized based on whether their country is well rich, and the others are still developing. So some people, you find that they're buying popular currencies like your US dollar, your British pound, your Japanese yen, your euro. Those are international forex trading pairs that a lot of people look into trading, right? So other popular currency trading instruments, it includes what we call Australian dollar, the Swiss francs, your Canadian dollar, your New Zealand dollar. So such pairs, they're also very popular as people trade in this forex trading market, right? So, like I said, you really need to learn so that you can also do this independently by yourself. So you can also understand and have that confidence to explain to another person in case if you want to give them all the information that they want, right? So we see that all these currencies can be traded through what we call spot transactions, right? The forwards, the swaps, the option contracts, whereby all these underlying instruments is based on currency, right? So, like I said, it's actually it continues to evolve around the world, right? So 24 hours a day, 5 days in a week, where people, you find that now at 3:30, right? Today in South African time, you find that some markets, are only opening at that time. Maybe it's still morning to in their country. They just woke up, right? Now, what do they do when they wake up? You do have those people who are involved in the stock market where they have to actually go to work and start opening trades and start performing transactions of all the financial markets that are involved, right? So you find that at 8:30, they get they go to work in the morning, but in our time, you find that it's still 3:30. So you find that there is actually quite a big aggressive movement in the market, right? Too much volatility in the market because of that movements in the market, right? So you need to understand who trades forex, right? Who trades forex? This forex market is not only have maybe many players, but many types of players. Here we're going to go through some of the major players or types of institutions and traders in the forex market, right? So number first, I love talking about the commercial and investments banks because of they bring the greatest volumes of currency that is traded in, between interbank markets, right? This is where the banks of all sizes trade, currencies with each other through what we call electronic networks, right? You find that these big banks, your all these commercial banks that all these big banks that right? These big banks account for a large percentage of total currency volume, and you find that these banks even facilitate, the forex transactions for their clients, even conduct, what we call speculative trades from their own trading desk. So you can imagine when people say that when people say that they are forex is about it's a they will say that they call it the market makers, right, or the banks making the market. The reason why they say that is because of they realize that the banks, they hold the greatest volume of currency interbank market, right? So involve so when the banks, you find that they act as leaders or dealers of for their clients, right? So they bid and ask the spreads, So they present the bank's profits. You find that they speculate currencies and they trade. And when, let's say, for example, now I'm a bank, right? So I'm a commercial bank. So I'm trading, right? So and now I'm executing my trades to make profits on currency fluctuations, right? So now you find that those currencies, they provide me what we call diversifications, or I'm diversifying my portfolio, or I'm making bigger returns out of my portfolio, right? Because of that fluctuations, right? Imagine if I'm doing this for over maybe 1 million clients, because you can imagine, banks, they do have a lot of many clients, which partner with each and every bank. They do have larger amount of clients because you realize that people are many in this world, right? So the central banks, what they present what we call their national governments. They're extremely important players in the forex market, right? So we're talking about the interest rate policies of their central banks, which even influence this currency rates of this very large extent, right? So we now talked about who are the large players. Now you know who are the large players. We talked about the commercial banks. We talked about the central banks, who are even responsible, for fixing the price of native currencies of the forex. These are exchange rate regime whereby you find that currencies will trade in the open market, right? And then the exchange rate regimes are divided into floating, right? The fixed and the peg types. So they're involved in all those kind of action. So any action taken by central banks in the forex market is done and stabilized, to increase you know, or competition between nations' economies. You find that we just comparing, we just converting in order for us to, benefit or profit from, all these fluctuations between one currency and another. So, and we talk about the investment, managers, the hedge funds. Here we're talking about people who are also managing the portfolios, right? You find that they do have pooled funds in one account, and they hedge those funds to make up, the second biggest collection of their players in the forex market. So these are also big players in the forex market, next to the banks and the central banks. So after the banks, we know that, oh, okay, there are investment managers, there are hedge funds, which follows. So you find that these investment managers, they trade currencies for larger accounts, such as, your pension funds, your foundation amounts, let's say now I'm actually working 9 to 5, and maybe I'm planning to retire after 60 years or 70, and so that I can get my pension. So imagine over the years, the banks will be trading your pension funds, right? Making more interest out of their pension funds. So and I had even in what was it? Which country was that? People were striking because of the government. They said they don't you can only once you retire after, or once you get 60 years, you're no longer qualifying for that. So this is infringing other people's rights as well. But otherwise, we find that these investment managers, with their international portfolios, they will have to purchase or sell currencies, right, to trade foreign securities. So these investment managers, they may also, find that sometimes they speculate forex trades, while some they even hedge funds. So let's say, for example, I'm buying Nasdaq, or I'm buying US 30, right, and then we find that they are selling, they are hedging against my trade, to say that if I lose, if whatever that I bought, if I lose, they already sold, on the other hand, so that whatever that I'm going to lose, they know they've hedged it. So that is what we mean by the hedge funds. You see, so and then you find that we do have multinational corporations. So multinational corporations, here we're talking about, the bigger firms that are engaged in importing and exporting, to conduct forex transactions to pay for goods and services. You see, so we consider, let's say, maybe for example, German solar panel, right? Maybe they produce, maybe they are the bigger producer, maybe at that time, and then maybe they import their goods and services to Americans, right? And then they sell their products maybe to China as well, right? After that final sale is made, you find that converted to euros because of the Germans, they were actually involved in this goods and services, right? This German firm, you find that they then exchange euros, for dollars to purchase more American components, right? So you find that these companies, when they make these transactions, they trade forex, right? That's trading forex to hedge this risk associated with the forex currency transactions. You see, so the same as German firm might purchase, this American dollars in the spot market, or maybe you find that they want to enter into the currency swap agreement to obtain dollars, right, in advance for purchasing components from America company in order to reduce what we call foreign currency exposure risk, right? That is involvement in forex exchange, right? You find this multinational corporations, they're also still, making a lot of money through this currency risk, and maybe offshore investments as well, right? So now we're going to talk about individual investors. These are me and you who are trading forex market, right? So these are individual people like any other people who trade forex, right? So of course, when we trade forex as individuals, right, as individual investor, or as an individual trader, or maybe as an individual beginner who doesn't know what they're doing, so you find that sometimes the volume of the forex trades is made up by what we call the retail investors. These are me and you. We are called retail investors. Why are we called retail investors? Retail investors are people who don't know what they're doing in forex trading, right? It's like maybe we have analyzed through, whatever strategy that we might have. But remember, we talked about bigger corporations being involved before. We talked about bigger banks being involved, the firms being involved in this, multinational corporations being involved in this. So now we're talking about individual, me and you, right? We trade in forex, but we are considered as retail traders because we don't know what we are doing. We just read maybe the PDF and think, oh, we know forex, and then we go and try our luck in forex trading. And what happens most of the time? You find that every broker, before you trade with them, they tell you that 90% of you won't make it. 90% of you won't make it in the first 90 days. Why? Because of they know that 90% of people surely, in the first 90 days, they will lose all of their 90% of their capital. That is what they know, and that is the deal, right? That is there, right? Because of they know, there's just a lot of manipulation behind. That's why I always say choose the best broker, right? Some brokers you find that they are A books, some you find that they are B books, and obviously the B books they're actually trading against your interest, right? You find that now you're buying, and what they're doing is they're trying to manipulate your trades, right? They're trying to sell against you. They're trying to make money out of your positions more than so that you can lose at the end of the day. So you need to be careful of such brokers, right? So we're also going to learn more about that. So as individual investors like me and you who are retail traders, or who are considered as retail traders, you find that most of the time, right? These investors, you find that they base their currency trades on combination of fundamentals. You find that we are only trading, what we heard from the news about a certain currency or about a certain stock or about certain crypto. So we're just following in, what we've heard from the media, right? And what what the media is feeding us, right? Sometimes the media can be very manipulative. They can just feed you what they want you to hear instead of them, telling you what's really happening. So like we saw in COVID-19, like we saw with these wars in Russia between Ukraine. So there's just a lot of propagandas that are closed doors, that media will never actually tell us about. So but moreover, let's say me as an individual trader, you as an individual trader, all of us as individual trader, we are only trading the fundamentals. We are only trading what we call the technicals, right? Technicals is whereby I just go and look at the charts and I start underlying my lines. I'm like, oh, I'm going to kill it today. I'm drawing my lines. I'm confident, and you're like, today, yeah, again, I'm killing it, right? So, but you find that immediately after you doing that, the market, goes against you. Because of you're a retail trader, you don't actually know what is really happening behind. We are only just buying maybe technical factors like your support, resistance, technical indicators, and your price patterns. So we're only limited to that, right? And you find that when the interest rate, maybe buying or selling based on the interest rate that is taking place at the time. And we know now we're experiencing inflation rates, right? Inflation rates, but now likely they've actually start cutting out the interest rate. I mean the inflation rates up until maybe December, right? So we'll see about that. So, but all these inflation rates, interest rates, we are trading based on what they have updated us, right? The monetary policy expectations, we're trading based on that, right? So, but how forex trading shapes business? I always say understand forex trading as a business owner, right? As a business owner, you know that there is a profit involved, right? There is a loss involved, and there is maybe expenditures or involved expenses or whatever. As a business owner, you know that uh, there is that as your statement, right? You need to balance that, right? So I also need you to understand forex as a business owner, as a business person, and it will shape you, right? To understand that okay, forex is also a business, right? And these are the results in maybe we sometimes you find that there are types of forex traders who are highly liquid, right? Highly liquid, I mean by, they're highly leveraged. They what can I say? They buy too much, right? They're aggressive, right? They're like, okay, I'm buying with a bigger lot size, right? So let's say maybe I'm buying Nasdaq right now. So instead of buying Nasdaq at a normal risk management lot size, right? I'm buying with maybe 10 bigger lot size because of I'm thinking I just want to make money now. I want to make money now. You see, so I'm going hard on it. Boom, 10 bigger lot sizes, right? And then obviously when you are highly leveraged, sometimes you find that people who are highly leveraged are short term as well, right? You enter a trade with high leverage, thinking that with just a small candle, I can just make, profit and get away with it, right? So, but sometimes you find that during the fundamentals or during the any events in the market, the news events, we go with too much pressure, thinking that okay, since the market is moving here, the market is volatile, there's too much speediness in the market, I can just make whatever that I want to make, with this bigger lot size. But what happens if the market turns against you? Are you willing to lose that income? That's where the major question comes in. Are you willing to lose that capital if you are risking that much? So most of my students, right, I'll tell them, use 0.01. You're a beginner, right? I'm still going to teach you the leverage. Have patience, right? Emotional intelligence is the first thing that you want to study. You want to be patient with the market. You don't want to go there with greediness. You don't want to go there with fear. You want to be flexible, but managing your risk properly, right? But you find that maybe behind closed doors, they just use 0.05, and then maybe they blow the account, they come back. And I say, please show me your full detail, report, your full detailed trading report. I want to see all the trades you were taking. I want to see all the lot sizes that you were using, because now here's the thing, all right? So when you're alone and you're trading, obviously there's just a lot of ideas that are coming into your mind. If now you made 100 rand, you're thinking, okay, so I made 100 rand. If I increase my lot size, it means I can just make 1,000, right? So now they increase their lot sizes. You start making mistake. You're not rational at that time. You're not making well-informed decision at that time because of what emotionally you thinking I can make more. So you're emotional now, right? So you being emotional at that time, you're also making major mistakes. You end up blowing your account, you're losing it all, going back to hustling. Giving yourself pressure and saying, okay, I'm a swing trader, this is my strategy, and I'm going to obey my strategy, right? Once you obey your strategy, then you know that you're just going to follow the rules. And once you follow the rules, you're avoiding to make any possible mistake. You're learning yourself to become a professional trader instead of being an emotional trader. So um, like I say, for instance, all this currency they carry what we call um, trading strategies that highlights how the market participants will influence the exchange rates, right? In turn, maybe they have spillover effects of the global market. So they carry trade, and some they executed by the banks, some executed by the hedge funds, some executed by the investment managers, right? And some maybe executed by the individual investors. So all of us, when we combine, we form that, you know, financial market, and we give it that liquidity, which is over 7 trillion every single day because of this major participant who are here, right? So, and when we trade forex trading, for example, let's say if Japanese yen, maybe has low yield, right? So you find that the market participants at the time, they would actually sell it because they see that it has low yield, they sell it, and then they purchase higher yield currency at that time. So let's say, for example, then I'll find pairs which I can, let's say maybe Japanese versus US dollar, right? Maybe Japanese at the time is low yield. So I will sell Japanese USD, right? Because of I'm seeing that no, it has low yield, but at the same time, because of I'm selling, Japanese US dollar, I'm actually buying the dollar on the other hand. So you find that you're selling the one that has low yield, but on the other hand, you're actually automatically buying the one with higher yield. You see, so you find that when the interest rate in higher yield, countries, let's say maybe they do have higher yield, maybe let's give an example, South Africa, maybe we've got higher yield, right? We will begin to fall back toward the lower yield countries, right? So that we can carry the trade and investors can sell higher and the yield profits. And then some, they can actually buy lower and then yield profits, right? So that is the strategy. And they may result in, what we call the broad decrease in global equity prices. So now we talked about everyone who is involved in the forex trading market. So here is the currency distribution of the FX market, and that's why we say that the dollar is the king of the forex market because the US dollar is the most traded currency and it's making up to 84.9% of all transactions, and then it's followed by the euro, which shares maybe 39.1%, while the yen actually is the third, which shares 19.0%. So as you can see, all these major currencies, they have their top spots on the list. So you find that traders, they love trading US dollar pairs, they love trading Japanese pairs, they love trading Euro pairs, all because, of that. But US dollar have been, probably noticed in most forex markets. So this US dollar is one of the it actually has, every half of every major currency pair, So you find that its measures comprise of 75% of all the trades, then it must actually pay attention to, all this currency composition of the world. So we talk about a lot of people. We find that they trade in US dollar GBP, US dollar JPY, US dollar Euro. So all of that. So now let's talk about the United States economy, which is the largest economy in the world, and we say it's the largest economy in the world because of its US dollar, right? Its reserve currency of the world is the most popular currency. So this United States has the largest and most liquid financial market in the world, right? So it's the first, country with the largest liquid financial markets in the world. So this United States, they have what we call stable political system, right? So, and they do have military power, superpower. You find that they even have international loans, and the bonds, they represent maybe half of international loans and bonds. And lots of these countries, in the foreign companies, they even borrow US dollar. So this US dollar actually is one of the median exchange between cross-border transactions. So we need to know all this. What is the powerful currency in the market, right? Because a lot of people speculate in the forex market based on that. So the main functions of forex market are, you find that a lot of people want to do it because they want to transfer funds from the currency of the country from one another currency. Because now if I go to Dubai, right? So I won't be able to use ZAR currency or my rents. I have to convert my currency into their currency so that I can be able to use their currency and buy whatever goods and service that I want to buy in Dubai. You see, so you find that because of that, that is also being involved in foreign exchange market, right? So some you find that they do provide short-term credit to finance trade between countries, and some they avoid or maybe hedge against foreign exchange rate fluctuation from the transactions of they received as payment at the time. So some they do it to speculate, like me and you, we're going to forex to what? To speculate, right? So that is what most people do. So, but we talked about the central banks being involved, the institutional investors being involved, your commercial banks being involved, even brokers. Another topic is about brokers, big topic about brokers, right? So you find that brokers, they are also, involved in this, but the brokers, they involved in that service to allow private individuals to access the forex market by transmitting their clients' orders to commercial banks or to trading platforms such as, your hotspot, FXall, all these different aspects. They get paid, from the spread. They get paid from charging a commission on each transactions. Any transaction that you're going to place in the forex market, the brokers are are earning commission for that. So also there are many brokers that operate as market makers, like your commercial banks. They even provide their clients with buy and sell, bid or ask prices to earn the spreads, right? If they are able to find the buyer or the seller at the same time, what will happen is if the market maker doesn't find any buyer or seller, they will try to make profit by covering its client's position on the what we call interbank market, right? So they will try to cover the expenses at the end of the day. You see, so that's why we say some brokers, you find that they're actually manipulating a lot instead of giving back, to the traders. So as a trader, in order for you to be a successful trader, you must find a good broker that serves your needs, a good broker that understands your role as a trader, and some brokers, in order for you to find a good broker, you must find them under the FSCA to see if they're licensed, they're regulated, they've got over-the-counter derivatives license, right, which allows them to facilitate over-the-counter financial market transactions. You see, so and some brokers, they'll find that they do have ODP licenses, but still, they don't deliver according to what they have promised to. Maybe they're introducing brokers or to their clients, right? So brokers gain. I always say broker is a salesperson. It's a salesperson before being a broker. So meaning that as a salesperson, it will make sure that it has to make money at the end of the day. At the end of the day. So that's why we say brokers, you find that they make 9 million each and every single day, out of all these transactions that are made between clients making transactions between one another or buying and selling of currencies. You see, so you need to consider that, you need to know that. So we're going to now talk about this is the euro pair, right? Let's say, for example, now you want to buy or sell. So you're buying maybe euro US dollar. This is your pair, right? So now this pair that you see on my screen here. So is let me share with you. Okay. So this is your currency pair, right? So you find that this is your base currency, which is your euro, and the US dollar is your code currency, and at the same time, it's quoted at a certain price, right? And like I say, when you buy, let's say when you're buying euro USD, you're actually buying, the euro, but automatically selling the dollar. You see, so that is how it is actually read, and that's how you actually read it. So yeah, so now you can actually know how to sell forex without, you know how to actually sell it without actually buying. So that's why you actually sell the other pair while you automatically buy. So if I want to sell maybe GBP USD, I'll just sell GBP USD. right? So, and if maybe I want to sell the dollar and maybe buy the GBP, I would actually buy the GBP US dollar, but knowing automatically I'm actually selling it on the other hand, you know? So that's how you read currency pairs. So you find that we do have major currencies, we do have exotic currencies, and we do have minor currencies, right? So we're going to dive deeper into what do we mean
it's
when
12
we say
o'clock.
there are major currencies, right? So while there are 8 major currencies in the world, there are only 7 major currency pairing in the foreign exchange market. This is because major currencies, they can involve your dollar base, your counter currencies in a trade, and of course dollar cannot be traded with itself, right? So it must be traded against one another. So uh, uh, there are some major currencies that we have. A lot of people do trade these major currencies. You find that they trade euro versus US dollar. They trade British pound versus US dollar. They trade US dollar versus Swiss francs. They trade US dollar versus Japanese yen. They trade US dollar versus the Canadian dollar. And some they trade Australian dollar, versus this US dollar, and New Zealand dollar versus the US dollar. So we look at the minor currencies and the exotic currencies. So these are coming from not well-developed countries, right? So those are major currencies because of they are from major countries, or they are from well-developed countries, right? They are traded most often because of they've got too much liquidity, right? As their countries are well developed, But minor countries, your exotic countries, you find that. Uh, this is where your Swiss francs, some, your euro fell in. So without this appearance of US dollar, here US dollar is not there under the minus and the exotic, right? This currency pair, you find that you only find maybe your euro GBP. These are euro versus British pound. These are British pound maybe versus Japanese, without the dollar that is involved, right? So the British pound versus the Swiss francs, the British pound versus the Australian dollar, the euro versus Japanese yen, and others without the US dollar. You see, so and then with the exotic currencies, we find that with exotic currencies, we are now looking at the term is used to actually um, mean these currencies are not coming from, or they are coming from the developing economy, right? The economy is still growing, it's not yet developed, it's still rising. So it's either they are base or counter currency with another major currency, right? We quote them with another major currencies. So often when they are trading with exotic currencies, we find that traders must be diligent, right? They must be as well experienced in the field, and they also need to establish some factors that can affect their currency value. So we look at all these exotic currency pairs, which involved your US dollar versus Hong Kong dollar, your Singapore dollar, your South African rands as well falls under the exotic currencies, right? Your Mexican peso, your what we call what was it, Swedish, the Indian rupee as well. So they all fell under the exotic currencies. You see, so why is dollar the most important? Right? We talked about it has been it has been actually the king for many history, right? So since 1944, right, their intention was to create what we call foreign exchange system that would actually promote economic growth on the international scale, right, by utilizing economic competition. So you find that other countries as well must actually use the dollar. But now countries are coming together to overthrow this US dollar, so we'll see if that will come into place, because the lesser people they use US dollar, obviously it won't be popular anymore, it won't be stronger anymore. So we see in other countries they're no longer trading using the dollar, right? They are trading using other currencies. So here on the screen, this is understanding you know, how people quote forex, right? So a forex quote is the price of the currency in terms of another currency. So these quotes are always involved currency pairs because of they are buying one and they are selling one another, right? Just like when you see on the screen. So this is your euro US dollar, for example. So guys, if you want to see the full cost, just go to YouTube. We are live on YouTube on Sarasel Favor Bank Motions, and you're going to understand and see on the screen what we're mentioning. And like I say, for example, this euro US dollar, right? So someone wants to make a deal or someone wants to order it, and through maybe buy limits, your stop orders, right? So you are able to place a trade or you are able to just buy at the market price, right? By just buying and executing your trade right now. Some people would just place a trade and say, okay, here's my limit. If the market approach my limit, let the limit be activated, or let my account be activated, or my trade be activated at the time. You see, that is understanding the forex code, how it is quoted, your euro being your base currency because it's representing the other, and the other being the code currency, right? So now we want to perform what we call bid and ask, right? So there must be what we call bid and ask prices. So when you're trading forex, this currency pair will always quote two different prices, right? So obviously, it shows you that the price of the dollar versus the euro at the time, so you bid means the price traders sell fx at, right? When you bid is like the price that you are selling whatever currency at, right? When you ask is the price traders buy your the forex at, right? If let's say I want to buy something, I'm just going to ask the price, right? So the bid sell, the bid, when you say bid, then okay, automatically in your mind you must remember, oh, it means sell, right? And then ask, it means buy, right? Automatically ask, it means buy. So that will actually picks up your mind very quick, right? When we say bid or sell, it means that the price that traders they can sell at. And when we say ask or buy, it means the price that the traders can actually buy their currency at, right? This make yes seem maybe confusing at some time, especially if you're new, right? It's only natural to think of a bid in terms of buying. So just remember the bid and ask, terminology is from the broker's perspective. So you can just say buy or sell, right? So and sometimes traders will always be looking to buy forex when the price is low, and they want to sell when the price rises, right? Or sometimes they sell forex in anticipation that the currency will depreciate, right? And then maybe buy it back at the lower price in the future. So that's how they actually make money out of it. You see, so now we talk about the spreads. So the spreads, you find that is the price to buy a currency, whereby it would be typically more than the price to sell the currency, right? That is where the brokers, you find that they're charging more money because that's where the money is, right? So the difference is called the spread, and it is where the brokers earn a lot of money by executing a lot of trades. Imagine now I'm a trader and maybe I make 300 trades in a day. So imagine how much a broker have made out of all the trades that I've actually positioned myself in the forex market. They've made a lot, So that's why, as an introducing broker, you need to find a broker that will share with you the commission on the spread, will share with you the commission, on the swaps as well, So sometimes the spreads tend to be tighter, sometimes the spreads tend to be lesser for even major currency pairs due to their higher trading volume and liquidity, right? The Euro USD is the most widely traded currency pair, so it is no surprise that the spread of it is 0.6 pips, because it's the most traded ones, so but there are top tips, for that I want to give for forex quotes. So when you buy or or sell, or when you bid or ask prices, you should know that you need to consider strategy. You need to have a trading plan that will help you, okay, I'm buying from this level. This is where I'm going to take my profit. And I'm selling from this level. This is where I'm going to take my profit. And this is where I'm putting my stop loss, to measure your risk, And I always say, Forex is a game of probability. It's a game of chances. It's like you putting money in order to find out whether you are right or wrong, So it's like you going to casino, right? You going to casino, you're going to put money into a machine, right? And then if maybe the machine says you've lost, you don't even have peace of mind. You won't fight about it, right? If now you go to mainland casino and you put in maybe 100 rand in anticipation to make maybe 300 rand and you lost it, you won't even feel emotional about it, right? So, but why do we have to feel emotional about it in forex trading when we lost? So, it's the same thing that we need to apply. It's the same thing that we need to teach ourselves so that we can have peace of mind. That's why I'm saying trade forex like a business. Understand all these costs that are involved. Understand there's a loss and there's a reward. But the most important thing is not to be afraid of taking risk, is to understand that there's risk and how can I measure my risk? How can I mitigate my loss? Right? Okay, I've got a 10,000 that I want to trade with. I'm only willing maybe to go a drawdown of 20%. That is like 2,000 drawdown, right? In order for me to make maybe 80% of the money, right? Which is overall 8,000 in profits. So you need to measure your risk. You need to know how much you want to target in order for you to make it at the end of the day. So we talk about the advantages and the disadvantages of foreign exchange market. So there are fewer rules. Let's start first by the advantages, because there's just great advantages about forex trading. There are only fewer rules in the other um, in the forex market. What do I mean by fewer rules? I mean that investors, you are not held up by strict standards or regulation found by other markets, right? You are free flow. You can actually just go there and open a trade and you are good to go, right? And then there are no clearing houses. There are no central bodies that oversee your forex market, that oversees all the your transaction that you're making, right? And most of the cases you find that these investors, you don't even have to pay like your traditional fees or your commissions, that would be involved in that other markets, right? So the great advantage is that here we're looking at the 24 hours in a day. You've got 24 hours in a day, free flow, 24 hours in a day. What can you do in the forex market when you're giving 24 hours in a day, right? You can just structure out your possibility on how much you can make. That's just a lot of opportunities. 24 hours means 24 hours, full of opportunities, right? You can trade at any time of a day, which means there's no cut out time, which means it gives you opportunity as a participant to the whole day of the market. And finally, here we're talking about the risk. If you're worried about the risk and the reward, you can get in and out whenever you want, right? So if I've placed my trade now and I'm worried about the risk, I can just get out, and cool off my mind, go obtain some emotional intelligence, clarity, so that I can come back with precision, So you can even buy as much currencies as you can afford based on your account balance and your broker's rules for leverage, right? So some brokers, they offer 1 is to 10,000, 1 is to 500, 1 is to 2,000. So you need to understand the broker's rule leverage so you can take advantage of the market the whole day based on how many possible positions you want to take, right? So now here we're looking at the disadvantages. The disadvantages. What can hinder us? Obviously everything has a risk and reward. So we've got pros and cons. So we need to look at the disadvantages. So although the market being unregulated, it brings advantages. It also creates risk, and there is also no significant oversight that can ensure the risk-free, transactions. So that's why I always say work with the brokers that are, licensed. It's well, the whole market, just can be risky because every broker is just coming. Hey, I'm a good broker. Hey, I can give you this. Hey, I've got tighter spread. Hey, all brokers, they are singing the same story. They're singing the same song. So you need to find the one you think is the better song for you. So looking at the leverage, right? So the leverage, can help magnify your profits. How? Let's say now I'm opening NASDAQ, right? Instead of using 0.01, I'm using 0.10. I'm actually what? Leveraging, right? I'm increasing my leverage so that I can magnify my profits, so that it can lead me to high profit. But you should know that leverage as well comes with high losses, right? Yes, you can be a highly leveraged person now, put all the leverage bigger loss sizes, but it comes with higher losses. I can lose it all at the same time if the market goes against me. As there are no set limits on leverage, investors stand no chance or no loss of any bigger losses of amount if their trades, move in the wrong direction. That's why I'm saying leverage is important. Understand the leverage, right? So unlike stock, you can even let's say maybe stocks, for example, they can even provide you returns through dividends and bonds, through interest payments, through FX transactions. Slowly, when you are relying on appreciation, meaning they have less residual returns, and let's say now as well it lacks transparency in FX market. The lack of transparency can actually harm a trader, as you sometimes you find that you do not have full control over how their trades are filled, how your best prices are quoted, and even how all this the limited view information. As like for quotes, the most important thing is the price, right? How much are you quoted at? So if that lacks transparency, then there should be another problem. So that's why I'm saying choose the best broker that that this will serve as my best interest. And here we talk about the traders, the commercial banks. We've talked about them. So we're going to explore more about trading strategies, right? How can we get started in forex trading market? How can we leverage and make money out of forex trading market? But first of all, I want to introduce you to forex risk, right? So yes, understand that there are risks that are involved in forex trading market, and sometimes you find that firms may be exposed to three types of foreign exchange risk, which are your transactional risk, your economic risk, your translation risk. So all of this, they form a major role in forex trading. These types of foreign exchange risk, let's talk about now the transactional risk, right? How you change, your exchange rate may affect the value of your foreign assets and liabilities, right? So you need to understand that as well as a trader, whether anything it has risk, anything in life has risk, so but understand how you're going to mitigate your risk, how you're going to simply understand the role of maximizing your profits, and you so that you can eliminate a lot of exposure to the upsides as well as the downsides of the movements, right? So that's what I actually wanted to touch more about, and that's the topic for today. At least we did cover almost everything that we needed to know, at least for basics as a beginner. So before we explore more into the market sentiments, what are market sentiments, right? So market sentiment, we talked about the fundamentals. Remember, I talked about which I use. We talked about the technicals. We say a lot of people will trade the trade support and resistance, right, in the markets. So now let's talk about what is a sentiment. So a sentiment refers to, the overall attitude of an investor toward a particular security or financial market. What is your behavior about that particular financial market? What is your attitude about that financial market? Here we're talking about a feeling, a tone of the market, or a crowd psychology. You find that a lot of people are just buying based on FOMO, fear of missing out. That is crowd psychology, and as revealed through this activity of price and movement of securities traded in the market, we see all those behaviors in the market, right? So, and in broad, let's say maybe the rising prices, we said it indicate the bullish market sentiments, right? So, meaning that a lot of people thinking it's the right time to buy, while falling prices indicate the bearish market sentiments, right? So all these market sentiments, it just refers to overall consensus about a stock or a stock market as a whole, right? An attitude to this stock market, right? What are people thinking at the time, right? So, and the market sentiments can be bullish when the price is rising. It can be bearish when the price is falling. And technical indicators can help investors measure their market sentiments, right? So, understanding the market sentiments as an investor, it's always, let's say market sentiments, also called as an investor sentiments, is not always based on fundamentals, right? This is not always based on fundamentals, but sometimes you find that day traders and technical analysts, they rely on the market sentiments, maybe as it influences indicators. And I just been informed that my Facebook actually live has gone off. So, but otherwise, guys, this has been a great beginner's course. And here, lastly, as we're talking about, the investors, having what we call the market sentiment based on the bearish and bullish movement, is when, when we say it's a bear, when we say bears are in control, we mean the stock prices are going down, right? When we say bulls are in control, we mean stock prices are going up, right? So, and all this emotion, maybe sometimes they drive the stock markets, and they also drive this stock market, this sentiment, they also drive this market, and they give maybe fundamental values as well, right? So all this market sentiments, it's about feelings, it's about emotions. What else? Fundamental value, it's about business performance. It's about the news related around crossover, right? What is business saying overall, right? Are the business performing well? That's why when we say, you find that some companies maybe within the Nasdaq are falling down. You find that as well, then the whole stock market is falling down if there are more companies not doing well at the time, So, and some investors, they profit by finding stocks that are, overvalued. Some, they trade based on the stock that are undervalued, based on their market sentiments. They use various indicators to measure the market sentiments that help determine the best, stocks to trade. So these popular sentiments indicators, they include your volatility index, your high-low index, your bullish percentage index, and moving averages. So, and these indicators, they do measure what we call the market sentiments. So let's talk about the VIX. When people trade VIX, they also, I also call it fear index, right? So when they trade this VIX, this fear index is driven by option prices, right? A rising VIX means an increased need for insurance in the market, right? And if traders feel that there's a need to protect themselves against the risk, it's a sign of increasing volatility, right? And when traders add more moving average to VIX, that helps determine its relative high and low. You see, so that's how you trade VIX. So, which, and we now talk about the high and the low index. The high and the low index compares the number of stocks, making between high lows. So, and we do have bullish percentage index, your moving average. Some people use moving average. You find that investors typically use 50-day simple moving average. And sometimes they're using, I love using a 200-day simple moving average when determining, the market sentiments. And even 50-day is really accurate. You can use both of them. Those are the lines that will guide you where the price is actually, moving. So when you find that when this 50-day simple moving average crosses above maybe 200-day simple moving average, is referred to golden cross. We call it the golden cross. This indicates that the momentum has shifted from the upwards. Now it's creating the bullish sentiments, right? And when this 50-day moving average crosses below the 200-day moving average, you find that there is a death cross. We call it a death cross because now the prices, is suggest that the lower the prices, they're generating what we call the bearish sentiments. So if you understand this is the best strategy, this is the best strategy that you can practice. You can just go to your under tools on your trading platform, and under moving average, you can then start adding your 50-day simple moving average as blue color. And you can then change this 200-day simple average to maybe I love putting it as a red color, right? So you can just put it as a red. So when they cross, you know that, okay, when 50 crosses with 200, then it means the momentum has shifted from the upwards. Because remember, 50 will be coming this way, right? And then 200 will be coming this way. And now they're crossing on between. So now it means, instead of the market going upward, it is now shifting, to the other side. It's just so and so. So you know that when this 50 MA crosses below the 200, it is now, generating that bearish sentiments. So understanding that strategy as well will help you. So, and I always say a trader must have 5 reasons why, or confirmed reasons why they are buying or selling. You must have 5 confirmed reasons before buying or selling any currency pair or any stock market or any cryptocurrencies. So that includes your fundamental, that includes your sentiments, that includes your technical, that includes as well, your intuition as well at the time, right? And your indicators. So there you've got a fulfilled, 5 reasons why, So we've got what we call the real world example of market sentiments, whereby in 2018, December, the market sentiment turned bearish, right? When several factors work towards, and a lot of things. Because now, firstly, we fear what we grew over the slowing corporate earnings, and after several years, they double-digit earnings growth for many companies. They grew up to 3 to 4%. They would increase in 3 to 4% earnings. And obviously, the reason why I'm talking about this is because of to help you understand that we've got what we call the Federal Reserve Chair, Mr. Jerome Powell, of which normally speak at the federal meetings. So this former, what we call Federal Reserve Chair, so which is FOMC, right? So it's an event into the forex market, which find that a lot of traders they do trade it, and now the market maybe at the time we're trading based on his comments, right? Maybe sometimes you find that he's hawkish, and maybe sometimes maybe he's slowing in the economy, or maybe any market sentiment that he might give. So we trade based on that, right? So otherwise, this would be like your chart in the market, whereby you'll have your prices quoted, and you also be able to have your RSI, which actually tells you all the bearish market sentiments evolved. So or the bullish sentiments, you can just, if it's above here, if it have increased your RSI, you know that automatically when it gets to this level, it then goes down. If you can check, it was up here RSI, and then now it started going down, right? Once it hit this point 100, then it start decreasing. Some people use different types of RSI based on their settings. So, and this is other strategy that people use in forex trading to trade forex market in different ways. So otherwise, I hope everyone have learned today. So thank you so much for joining us today, and have a lovely Make sure you don't forget to subscribe so that you can join our next masterclass full of joy. We will be bringing you exciting people who will be teaching us more information and giving away. This is a Forex bootcamp, guys. So as a Forex beginner, course, and from beginner's course to understanding. So from chapter 1, we spoke about we talked about the overview of forex. We explained what is forex, what does the forex stands for, right? We did emphasize the size and liquidity that highlight that forex market is the largest financial market globally, and with a lot of trillions of dollars being traded each and every single day. And we did mention to you guys that you've got 24/5 availability due to your global nature, whereby you can trade anytime in the market, right? And we discussed as well who are the market participants, right? We did describe the market participant in the forex market, which includes your banks, your corporations, your central banks, your institutional investors, even retail traders like me and you, and other speculators as well, right? So we did talk about on our point 1, we did talk about the currency pairs. We did define what is a currency pairs. We did explain, uh, why people trade these currency pairs, based on well-developed countries like USA and some developing countries, right? We did mention that we do have major currencies, we've got minor currencies, we've got exotic currencies as well, or pairs. So we did even give you example of all those different pairs that may be involved in forex trading. As a beginner, you need to have all that broad understanding so that you understand almost every sentiment in the market. We did discuss currency symbols, and we did even talk about deeper about the institutional investors and the corporations. We did highlight that large institutions and corporations, they engage in the forex to manage international business transactions. Some, they are there to hedge, what we call currency risk. Some are there to seek investment opportunities. So, and we talked about us being retail traders, me and you, whereby we can even be speculators, right? Here's whereby we discuss how individual retail traders and speculators participate in the forex market, right? We are seeking for profit from currency price. And we did talk about factors influencing the forex markets, which can be your economic indicators. We did explain how economic data work, your GBP, your inflation rates, your impact currency valuations, and the market sentiments. And we did touch more about the geopolitical events that may be involved, whereby we talked about, even politics instability, can affect the market. Even international conflicts can affect the market. Even trade policies can affect the market. Even diplomatic relations they can even cause a major effect in this currency markets or currency values, right? We did talk as well about the market sentiments and the risk appetite, whereby we did describe how the market participant, perception works, the emotions and the influence that you can have in the currency market, whether the demand and supply leading to the market trends. So almost everything for the first beginner chapter, it was worth it. So now, guys, just a reminder as well. We will be on the next topic. We'll be talking about trading psychology on the book that we wrote about trading psychology. So make sure that you don't miss out on that one. From this, this is the beginners course. Secondly, we'll be discussing the trading psychology of the market, and the rest from there will be getting deeper into the technical analysis and analyzing with you the charts and the patterns. And we'll be talking about the fundamental analysis, analyzing with you the news and every factors in the fundamentals world that can affect the market. And lastly, will be as well understanding the sentiments. Today we did touch a little bit about the sentiments, but in the next topic we'll be discussing how people trade the sentiments, right? How that fear and emotion can cause us to buy and sell. Just like in COVID-19, you find that a lot of people thinking, oh my God, we just locked down in the houses. And by then they've given the stimulus money. So, at that time, a lot of people have a lot of money at that time because the government gave you money, but they've locked you down in the houses. So sentimentally, so a lot of people just take that money into the stock market and trade. So you find that the market is it also grows, it goes up because of a lot of people are just home there trading, and some people are want to trying it out. So where there's liquidity, and there's money, but sometimes as well, I always say, don't be the liquidity. So see you next time.